Welcome back guys to another tip of the day video, and in today's tip of the day video we will be going over what is volatility and how can we understand it better. First things first, when you hear somebody say, oh man, the market was extremely volatile today, what does that necessarily mean? Well, volatility represents how large the range in terms of the stock price can swing around the mean price. We measure this in standard deviations. You know, the bell curve that you were taught in statistics class? Pull up a bell curve and we take a look. Well, one standard deviation, which we see right there, has 68% of the data. That means 68% of the times the price should fall within the one standard deviation range. It goes a little bit further. Then we have a two standard deviation. And in a two standard deviation, 95% of the time the price should fall within a two standard deviation range. And it goes a bit further out and we look at a three standard deviation. And now a three standard deviation is going to capture the price 99.7 of the time. So for the most part, we should see within a given period of time the asset fall within three standard deviations. Most of the time, one standard deviation. However, there are those outlier events, earnings, news around the stock that can make the stock run 1, 2, 3, 4, 5, 6, etc. standard deviations. However, once we hit 3, you can see it tapers off for the most part. You can see it flattens out and then it just becomes, the change is so tiny the higher the standard deviation is, because it's a very outlier event for that to happen for the most part. So when it comes to volatility, we know that it represents on how large that the price and swings around the mean. We know a way to measure volatility is through standard deviations. And we know a volatile asset is more riskier than a less volatile asset because the price swings more, making it less predictable. Also, volatility is used to calculate the options price, which we're not going to get too deep into that, but it is important to know that. Now, volatility has two types. There's historical volatility and implied volatility. So first we'll start with historical volatility. And historical volatility is how it sounds, historical, a history of prices. So it takes the previous ranges in that asset class, whatever the stock is, whatever the index is, it takes the previous ranges, calculates that out into a number in a decimal form. And we can find that on any stock in the options chain under the options statistics. Take Apple, for example. We pull up Apple's option chain that's located under the trade tab, and we can see under the option statistics, we can see that Apple's historical volatility is 32%. So that takes all the previous ranges that Apple's gone through and it gives us a number, 32%, 0.32. Historical volatility is nice. It's good to understand that. However, we're going to use the other type of volatility. Implied volatility is a more practical measure for us to gauge a stock's volatility going forward. Implied volatility is a price forecast for future dates, and we can see that Apple's under the option statistics has a current implied volatility of 35%. So its historical volatility is 32, but the implied volatility is 35. So typically when the IV is higher than the historical IV, the option is going to have a higher premium in the options market if you're buying or selling calls or puts. When it's less, the IV, it's at a discount. You're buying it at a better price because volatility, think of volatility always expands and it comes back, like lungs breathing. So when you're buying a higher IV, it's going to contract over time. So you're paying up for the premium and then it contracts. So you're losing money to decay, versus when you buy something lower in volatility and volatility rises, now your option price is increased in value just because of the fact that IV has increased. That's the premium baked into that option. Now, IV in bull markets tend to drop And in bear markets, it tends to rise. But right now, we're going through such volatile times, we have high volatility. Some read we can get on volatility is the VIX. And the VIX is basically the volatility of the S&P 500, the SPX. It's really complicated, guys, and I don't want to get too in-depth into this stuff, but the VIX is a quick, dirty read on the general market. At a 27 VIX, we look historically, 27 is kind of high for the VIX. You can see right here, you can see it comes down and then it comes up, almost like a breathing, how you breathe. See? It expands, contracts, expands, contracts, expands, contracts, expands, contracts. You get the idea. There's also VIX futures, and the VIX futures are forward looking. So we have the VIX index, which VIX, the VIX is just 30 days out. It doesn't get a good read going further out looking on things. So the VIX futures gives us an idea of where volatility could possibly be going in a future date. And I'm going to throw one more at you guys. Then there's the VVIX, and the VVIX is simply the volatility of the volatility. You can't buy this instrument, but it's general index to get an idea of, are times volatile, are times less volatile? You can get a quick dirty look, and seeing the VVIX at a 120 is high when we look at it historically. You can see historically in the VVIX, it likes to spend most of its time in the 80 to 90 range, which right now we're elevated. We're in a higher in volatility times. Now we can use volatility to compare different assets. Now take Apple, for example. We can see Apple has a lot of different implied volatilities on the right-hand side, and that's for each option contract. Each contract is for a different date. Each date is going to have a different value. So overall, when we see the implied volatility at 35%, that just takes the average of all the implied volatilities in the option chain. But each one has its own number. So let's take Walmart and compare the two. So we look at Walmart, and Walmart has 18, 22, 23, 26, 28. Walmart is significantly lower than Apple in terms of volatility, meaning it's not going to swing as much. Walmart is a brick and mortar. They do online sales as well, but Walmart is a nice, stable stock. It's not going to have those wild swings like we do. Like, even take a look at Tesla. So we type in Tesla, and we look at Tesla's implied volatility: 48, 99, 88, 91, 80, 83, 71, 79, 78, 72, 79. You can see that Tesla has a higher implied volatility, meaning it's going to swing as more. So simply taking an IV on one stock and an IV on another stock, you can get a general ballpark. Well, this is a more riskier stock versus a Walmart with a lower implied volatility. So depending on your risk aversion, how much risk can you tolerate? Do you want a higher implied volatility or a lower implied volatility? Which is going to give you an idea of, will the stock swing a lot, or will it be a slow mover like a Walmart, like a Target, like a Home Depot? These are all going to be lower implied volatilities versus like a technology stock that's so volatile. A lot of things can happen. I could go extremely in depth into volatility, but I really want to just touch the surface and understanding that volatility simply means how much an asset can swing in terms of price. And just looking at the implied volatility, we can get a quick read on is this stock more volatile than X stock, and you can compare the two. We'll go one further. Now, the expected move, you hear me talk about it, but the expected move is derived by the implied volatility. So you can see we have the implied volatility on the left, and then we have the expected move on the right. The expected move is in terms of dollar amount. Knowing the percentage is good to compare cross sectors, cross different stocks. However, if we want to know what that specific stock can move in terms of stock price, we look at in the parentheses, and that is a $12. That's only in the 1 day out. 8 days out, it's showing that Tesla could move $55. So a higher IV obviously means a higher price movement in swings. So that's how that number is derived, and we use this expected move in just about everything we look at. So when I look at the SPX on Friday, and I want to see, well, what's it look like for a full week in advance? Well, we would go to the October 23rd, so that's a Friday coming up, and we can get an idea that, okay, well, they're pricing in right now in this current time in $86 up or down in the S&P 500 between now and next Friday. So knowing these numbers gives us an edge in trading. So don't be afraid of understanding volatility. Volatility will give you an edge and make things a little bit easier to understand overall. There you have it for today's tip of the day, guys. Volatility and understanding how we use the volatility for the expected move. Volatility is a very complex instrument. However, we can pull little bits and pieces of it that can kind of give us an edge in trading and understanding the market a little bit better. I hope you've enjoyed today's tip on the day, guys. If you've enjoyed today's tip, hit that like button. I really appreciate it when I get a like on a video. And if you're not subscribed to the channel, I do daily stock market breakdowns Monday to Friday, just a macro perspective on what the stock market did as a whole. Just think of it as gears turning, what each gear did, and I just quickly break it down for you in about a 10-minute video. But on that note, guys, I will see you in the next one. Have a great day. Take care. Peace.